When a central bank changes policy, most people assume it's background noise, something technical, something that won't touch our daily lives. On December 1st, 2025, the Federal Reserve quietly ended quantitative tightening. There was no alarm and no emergency headline. But that single decision resets how your money moves going into 2026, and likely for the years after. Here's what almost no one tells you. This shift doesn't stay inside policy rooms. It shows up in your savings account, your mortgage rate, stock prices, and the cost of everyday expenses. The last time the Fed made a move like this back in 2020, the outcomes weren't even. Asset owners moved ahead. Everyone else felt squeezed, even while doing nothing wrong. The usual explanation is effort or timing. That wasn't the real cause. A structural system was. In plain terms, ending quantitative tightening means the Federal Reserve is preparing to add liquidity, again, supporting markets and boosting activity as we head into 2026. If you're new here, I'm Alex. Today, we'll break that system down in layers, starting with what the Fed just changed, then how money reacts, and finally why the same wealth split keeps repeating whenever policy flips. When you understand this shift, you position yourself very differently than those who don't. The last time this happened, it produced the largest wealth transfer in modern American history. The place to start isn't theory. It's understanding why a quiet decision on December 1st is already shaping outcomes most people won't recognize until much later. The last time this happened, everything split. In early 2020, two people could earn the same salary and make equally reasonable choices, yet end up in completely different financial positions 2 years later. One owned assets, the other held cash. That single difference quietly decided the outcome. When the Federal Reserve flooded the system with liquidity, the stock market didn't rise gradually. The S&P 500 jumped about 18% in 2020, then another 28% in 2021. Home prices didn't edge up. They surged roughly 13% one year, then close to 18% the next. On paper, the economy looked like it was healing. But something else was happening at the same time. Inflation climbed from near zero to around 9%. Rent increased. Groceries cost noticeably more. Gas prices spiked. Wages moved, but slowly, and not enough to keep up. Real weekly earnings actually fell during that period. So while asset owners watched their net worth expand without extra effort, cash savers saw their purchasing power shrink, even though their account balances barely changed. Nothing felt dramatic day to day. There was no obvious moment where things broke. The split happened quietly, then compounded. That contrast wasn't random. It followed a pattern the system has used before, and the conditions that created it are starting to line up again. Why some people got rich, while others fell behind. During the same 2-year window, outcomes diverged in a way that still confuses people. One group felt like they were moving forward without changing much. The other felt like they were running harder just to stay in place. If you owned assets, the math worked in your favor. Stock portfolios rose with the market. Home equity expanded as prices climbed faster than incomes. Even people who didn't add new money saw their net worth increase simply because prices moved upward. If you didn't own assets, the experience was different. Paychecks arrived on schedule, but each one covered less. Rent renewals came back higher. Grocery bills grew without adding more food to the cart. Insurance, utilities, and transportation costs crept up at the same time. According to labor data, real earnings actually declined during that period, meaning raises didn't keep up with prices. What made this split especially frustrating is that effort wasn't the deciding factor. Plenty of disciplined savers did everything they were told to do. They avoided debt, kept money in savings, and delayed purchases. On paper, that looked responsible. But the system rewards exposure to asset inflation, not patience in cash. When new money enters the economy, it flows first into markets, and balance sheets, not wages. That gap widens quietly. By the time it becomes visible, the distance is already hard to close. And once you notice who benefited, another question starts to form. The quiet way, money loses value. Take a simple situation. Someone keeps $50,000 in a savings account. The bank pays around 3%. On paper, that feels safe. The balance grows by about $1,500 a year. Nothing looks wrong. Now, add inflation back into the picture. When prices rise 4 or 5%, that same account is losing more purchasing power than it's gaining. Groceries cost more. Rent resets higher. Insurance premiums jump. The number on the screen increases, but what that money can actually buy shrinks. This is why cash losses rarely feel urgent. There's no alert, no statement showing the real decline. The loss shows up later when a down payment feels further away or when the same emergency requires more money than expected. The damage is delayed, not dramatic. Compare that with someone who placed the same 50,000 into a broad market index. Over time, returns have averaged well above inflation. Even in uneven years, the growth tends to outpace rising prices. The difference isn't intelligence or effort, it's exposure. Savings accounts are designed for stability, not growth. They preserve nominal value while quietly sacrificing real value. And once inflation picks up, that trade-off becomes expensive. Most people don't notice until years pass and the gap feels permanent. What the money flood actually did. When the Federal Reserve expanded its balance sheet after 2020, the effects showed up faster than most people expected. Within 2 years, total assets held by the Fed more than doubled, rising from roughly $4 trillion to about $9 trillion. That money didn't sit idle. It moved first into financial markets. Stocks rebounded sharply and kept climbing. The S&P 500 gained about 18% in 1 year, then nearly 30% the next. Housing followed the same path. Prices rose by double digits in consecutive years, even as mortgage rates were still relatively low. Monthly payments didn't look extreme yet, so demand kept building, but everyday costs reacted differently. Grocery prices didn't spike overnight. They rose quietly, trip by trip. Rent increases showed up at renewal, not at the register. Utilities, insurance, and transportation crept higher at the same time. Each increase felt manageable on its own. This is how liquidity works in practice. Asset prices respond immediately because markets reprice instantly. Living costs adjust slowly, then all at once. By the time households felt squeezed, asset owners had already locked in gains. That timing gap explains why the same policy felt stabilizing to some and destabilizing to others. And it hints at what happens when the flow starts again. The game the Fed is actually playing. The Federal Reserve doesn't react to everyday prices the way households do. It reacts to pressure inside the system. When growth slows or markets wobble, liquidity becomes the priority. Money gets cheaper. Credit loosens. Borrowing accelerates. That's when expansion happens. When inflation climbs too far, the response flips. Rates rise, lending tightens, money supply contracts, spending slows. On paper, this looks balanced. In practice, the timing matters more than the intent. Financial markets respond first. Stocks reprice within minutes. Bond yields adjust immediately. Real estate follows once financing costs shift. Wages don't move that way. Raises happen annually, if at all. Contracts lag. Labor adjusts last. This delay isn't a flaw in execution. It's a feature of the structure. The Fed's mandate is financial stability, not income protection. Stability means preventing market collapse, bank failures, and credit freezes. If asset prices fall too fast, confidence breaks. That's what they avoid at all costs. So liquidity flows toward balance sheets before it ever reaches paychecks. That's why asset owners feel relief early, while everyone else feels pressure later. The system isn't designed to feel fair in real time. It's designed to hold together. Once you see that priority clearly, the pattern behind past decisions starts to look familiar. Why the Fed had to hit pause. By 2022, the Federal Reserve shifted from flooding the system to pulling money back. Interest rates rose quickly. Bond purchases stopped. The balance sheet began shrinking, eventually falling from about $9 trillion to a little over $6 trillion. On paper, the goal was simple: slow inflation by making money harder to access. The effects showed up fast. Mortgage rates doubled and housing activity cooled almost overnight. Businesses delayed expansion because financing costs jumped. Stock markets turned volatile. Hiring slowed. The economy didn't break, but the strain became visible. At the same time, something less obvious was happening. Cash inside the banking system was draining. Bank reserves, the buffer that allows institutions to settle payments and handle withdrawals, moved lower quarter after quarter. That's not a headline problem until it suddenly is. This is where tightening stops being theoretical. When liquidity gets too thin, small disruptions turn into systemic risks. Lending freezes, credit markets seize, confidence evaporates. The Fed has seen that movie before. So the pause wasn't a victory lap over inflation. It was a pressure release. They slowed the drain not because everything was fixed, but because continuing would have stressed the system in places most people never see until it's too late. The problems they don't say out loud. Behind the public explanation, two quieter pressures were building. The first was inside the banking system itself. As tightening continued, reserves kept falling. That's the cash banks rely on to clear transactions and meet sudden demand. When reserves get too low, lending slows not by choice but by necessity. This isn't theoretical. In past cycles, shrinking reserves have triggered overnight funding stress and emergency interventions. Those problems don't start on Main Street. They start between institutions, then spread outward. By the time the public notices, the response window is already narrow. The second pressure was the labor market. Hiring didn't collapse, but it softened. Job openings declined. Layoffs ticked up in rate-sensitive sectors. Wage growth slowed. None of that signals a recession on its own, but combined with tight credit, it changes the risk profile quickly. For policymakers, this creates a dilemma. Keep tightening, and you risk breaking plumbing most people never think about. Ease too early, and inflation doesn't fully reset. Neither option feels clean. That's why the official language stays careful. Stability depends on confidence, and confidence depends on avoiding visible stress. But the decision to slow tightening wasn't driven by comfort. It was driven by thresholds getting closer than they were willing to admit. The faucet turns back on without saying so. 10 days after tightening officially stopped, a new program appeared, with a technical name and a calm explanation: reserve management purchases. On the surface, it sounded routine. Short-term treasury bills, liquidity maintenance, nothing dramatic. But mechanics matter more than labels. When the Federal Reserve buys treasury bills, it doesn't use existing money. It creates new reserves and injects them into the financial system. Bank balances rise. Funding pressure eases. The balance sheet expands again. This looks different from past easing only in presentation. The effect is familiar. More liquidity lowers stress in markets. Short-term rates stabilize. Risk assets breathe easier. The system feels less constrained. The distinction being emphasized is intent. Officials stress this isn't about stimulus. It's about smooth functioning. But markets don't respond to intent. They respond to flow. When money starts moving back into the system, prices adjust accordingly. That adjustment doesn't happen evenly. Financial assets respond first. Credit conditions loosen quietly. Then expectations shift. The language stays restrained, but behavior changes. This is why the timing matters more than the terminology. The pause wasn't the end of tightening, it was the transition point. And once liquidity starts returning even cautiously, the direction becomes harder to reverse than most people expect. Why this cycle never really ends. Every time the Federal Reserve tries to step back, the system pushes back harder. We've seen this pattern before. In 2018, rates rose and the balance sheet shrank. Markets dropped sharply. Within months, policy reversed. In 2022, tightening accelerated again. This time, banks started to wobble. Silicon Valley Bank collapsed. Others followed. Intervention returned almost immediately. The reason is structural. Modern markets are built around cheap credit. Corporations refinance constantly. Real estate prices assume affordable mortgages. Equity valuations depend on low discount rates. When money tightens too quickly, stress doesn't show up gradually. It snaps. So tightening always runs into the same wall. Something breaks before inflation fully resets. Liquidity gets reintroduced not because the cycle is complete, but because the alternative feels worse. This creates a loop. Easy money inflates assets. Inflation rises. Tightening begins. Stress appears. Policy eases again. Each round leaves prices higher than before, while wages struggle to catch up. What makes this frustrating is how predictable it is in hindsight. The tools don't change. The responses don't change. Only the justification does. And once you recognize that pattern, the important question isn't whether the cycle will repeat. It's where you're positioned when it does. When politics enters monetary policy, in theory, the Federal Reserve operates independently. Decisions are supposed to follow data, not elections. In reality, pressure builds long before policy statements change. Leadership matters. The Fed chair sets the tone frames, the risks and influences, how aggressively the committee acts. When that position is about to change, markets start pricing behavior before it happens. Expectations shift early. Political incentives are straightforward. Lower rates lift asset prices. Stock indexes rise. Credit becomes cheaper. The economy feels stronger in the short term. That's visible, immediate, and easy to point to. Inflation, by contrast, shows up later and spreads quietly. This is why rate cuts are always easier than rate hikes. Cutting feels helpful, tightening feels punitive. And when unemployment edges higher or markets turn volatile, the pressure to ease intensifies fast. Even without direct orders, alignment happens. Policymakers respond to the environment they're operating in. When growth weakens and elections approach tolerance for restraint drops, none of this requires a conspiracy. It's a feedback loop between markets' leadership and public reaction. But once politics enters the equation, policy bias becomes asymmetric. That asymmetry matters because it changes how long easing lasts, how quickly tightening ends, and who benefits most from the timing. What this sets up next. When liquidity starts returning, the early effects rarely feel dramatic. Rates drift lower, credit conditions ease, markets stabilize. To most households, nothing looks urgent at first, but the direction matters more than the speed. Cheaper money encourages borrowing. Businesses resume expansion. Investors take more risk. Asset prices respond before incomes do. That sequence has held across cycles. Inflation doesn't need to surge to cause damage. Even 4 or 5% quietly compounds. Rent increases renew annually. Insurance resets higher. Everyday costs creep while paychecks lag. The squeeze shows up months later, not immediately. At the same time, asset owners benefit from the same conditions. Stocks reprice upward on expectations alone. Real estate values respond to lower financing assumptions. Balance sheets inflate before new money ever reaches the broader economy. This creates another gap phase, not a crash, not a boom, a widening. People positioned inside the asset system feel relief. People outside it feel pressure without a clear cause. What makes this moment different isn't the tools being used, it's how familiar the setup looks. Liquidity easing before inflation fully resets. Structural incentives favoring markets over wages. The early signals are quiet. By the time the consequences feel obvious, positioning options tend to narrow. That's why this phase matters more than the headlines attached to it. Key takeaways. What matters most in this cycle isn't prediction, it's recognition. The same forces keep repeating because the structure hasn't changed. Liquidity enters the system to stabilize markets, not to protect purchasing power. Asset prices respond quickly. Wages respond late. Cash absorbs the gap. This creates outcomes that feel unfair, but are mechanically consistent. People who hold assets experience relief early. People who rely on savings and income feel pressure later, often without a clear trigger. The difference isn't effort or discipline, it's positioning inside the system. The uncomfortable insight is that stability for markets can coexist with instability for households. That tension isn't a failure of policy, it's a consequence of priorities. Once you see that pattern, the noise fades. Headlines matter less than direction. Labels matter less than flow. The question stops being, what did they say, and becomes, where does this leave me exposed? That shift in thinking is where control starts to return.